Listen to me very, very carefully, because what I'm about to tell you could genuinely be the stark difference between a comfortable, stress-free retirement and, I'm not exaggerating, facing the indignity of eating cat food in your golden years. I'm serious. We need to have a brutally honest conversation right now about something that sends shivers down my spine when I analyze the data. And believe me, I dissect financial data every single day. It's my life's work. I'm Mr. Wonderful, and I don't sugarcoat the truth when your hard-earned money is on the line. Before I reveal the 3 safest exchange-traded funds, ETFs, that every single retiree or soon-to-be retiree must own, I need you to do something for me immediately. Hit that subscribe button, smash it. Why? Because this channel is singularly dedicated to protecting your wealth, boosting your cash flow, and ensuring you never ever run out of money. If you are serious about securing your financial future, you absolutely need to be a vital part of this community. So subscribe now and turn on those notifications, because the information I share here could quite literally safeguard your entire retirement. Now let's talk about the harsh reality unfolding out there. I encounter people every single day, good, honest, hardworking individuals who have done everything right. They diligently saved, they meticulously put money into their retirement accounts. They dutifully followed the advice of their financial planners. And you know what? They're utterly terrified. They are absolutely paralyzed by fear because they look at the volatile market, watching their account balances soar one day only to plummet the next. They can't sleep at night. That is no way to live when you're supposed to be finally enjoying the hard-won fruits of your labor. Here's the brutal truth that almost no one has the guts to tell you. Most retirees are woefully unprepared for a major market crash. They think they are, but they simply aren't. Their portfolios are either crammed with individual, high-risk stocks, or they're invested in funds that are far too aggressive for their age, or even worse, they're sitting on stagnant cash, earning precisely nothing while inflation relentlessly devours their purchasing power like a slow, agonizing disease. Every single one of those strategies is a financial disaster just waiting to explode. You want to know what truly keeps me awake at night? It's certainly not my own portfolio, I can assure you of that. It's the chilling thought of millions of people who are just one significant market correction away from being forced back into the workforce at 75 years old. That's a tragedy. And it's a tragedy that is entirely preventable if only you know what you're doing. I'm going to tell you something that might surprise you, coming from me. When you're in retirement or even nearing it, you simply cannot afford to be a cowboy with your money anymore. The entire game changes. When you're young, you have the luxury of taking risks. You can swing for the fences. You can throw money into speculative growth stocks, meme stocks, cryptocurrency, and all that volatile garbage. Why? Because you have the most valuable asset of all, time to recover if things go south. But when you're retired, that luxury vanishes. You don't have 30 years to patiently wait for the market to rebound. You need that money now to pay your bills, to maintain your lifestyle, to genuinely live your life. This is precisely why I am obsessed, unequivocally obsessed, with safety and cash flow in retirement. Notice I emphasized both, safety and cash flow. You need these 2 vital components working in perfect harmony. You can't just hide your money under a mattress, and you certainly can't simply chase the highest yields without a profound understanding of the inherent risks. You absolutely need a strategy that zealously protects your principal while simultaneously generating reliable income that you can actually live on. And that, my friends, is precisely what I'm going to show you today. The 3 exchange-traded funds I'm about to reveal are not sexy. They are not going to make you rich overnight. They are not going to miraculously double your money in 6 months. But you know what they will do? They will meticulously protect you when the market inevitably crashes. They will consistently pay you reliable dividends, and they will allow you to sleep soundly at night, secure in the knowledge that your retirement is safeguarded. That, my friends, is worth infinitely more than all the reckless gambling in the world. Let me explain why ETFs are the perfect vehicle for retirees. First and foremost, they provide instant diversification. Instead of pinning all your hopes on a single company that could face bankruptcy tomorrow, you instantly own hundreds or even thousands of companies within a single, convenient investment. This ingeniously spreads out your risk. Second, they are remarkably liquid. You can sell them any day the market is open. Try doing that with a piece of real estate or a private business. And third, their fees are incredibly low compared to traditional mutual funds. I absolutely detest paying fees. Every single dollar you pay in fees is a dollar that isn't working for you, isn't generating dividends, isn't compounding exponentially. Fees are the arch enemy of wealth. But here's where most people go wrong. They mistakenly believe all exchange-traded funds are created equal. They are not. There are thousands of them out there, and frankly, most are utterly useless. Some are dangerously aggressive. Some are far too concentrated in a single volatile sector. Some are riddled with exorbitant fees that will slowly bleed you dry over time. And some are simply poorly constructed products designed solely to enrich the fund company, not you. This is precisely why I dedicated months to rigorously researching and analyzing to pinpoint the 3 safest options for retirees. I meticulously scrutinized historical performance during every major market crash. I analyzed dividend yields and the consistency of dividend growth. I dissected expense ratios. I drilled down into their underlying holdings. I examined everything because when it comes to your precious retirement money, you simply cannot afford to make a single mistake. One ill-advised decision can cost you years, if not decades, of hard-won financial security. Now, before I reveal these 3 specific funds, I want to ensure you grasp something profoundly important. The primary goal here is not to get rich. If you're retired and you're still trying to get rich, you're playing an entirely different and frankly, much riskier game. The overarching goal is to preserve your capital and generate consistent, reliable income. That's it. Boring, perhaps, but you know what's anything but boring? Having more than enough money to do whatever you desire for the rest of your life without the constant gnawing anxiety of running out. That, my friends, is true financial freedom. That's what we are diligently building here. You see, when a market crash inevitably strikes, and trust me, it will strike, most people succumb to panic. They watch their portfolios plummet by 20%, 30%, and they impulsively sell at the absolute bottom because they simply cannot tolerate the pain. That, without question, is the single worst thing you can possibly do. But with the right exchange-traded funds meticulously in place, you don't have to panic because you possess the unwavering confidence that you are protected. You know you are broadly diversified. You know you are still consistently receiving those vital dividend payments, even as the market descends into chaos. I've personally navigated multiple market crashes throughout my career. I've witnessed people lose everything, but I've also witnessed individuals who were smart, who were meticulously prepared, who barely flinched when everyone else was in a frenzied panic. The critical difference between these 2 groups? Strategy. It's having the correct investments locked in before the storm hits. You don't buy fire insurance after your house burns down. You buy it long before. So what are these 3 indispensable exchange-traded funds that I implicitly trust with retirement money? I'm going to walk you through each one with meticulous detail, and I need you to pay very close attention because the specifics matter profoundly here. This isn't just about blindly buying something because it sounds appealing. You need to intimately understand exactly what you own and, crucially, why you own it. The first exchange-traded fund on my meticulously curated list is a dividend aristocrat fund. Now, what precisely is a dividend aristocrat? These are elite companies that have consistently increased their dividends every single year for at least 25 consecutive years. Just let that sink in for a moment. 25 years of perpetually raising dividends means these companies have successfully navigated multiple recessions, endured numerous market crashes, and survived countless global crises, yet they still found a way to consistently pay shareholders more money year after year. That, my friends, is the epitome of the quality and unwavering stability you demand in retirement. This specific fund is packed with financial titans like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These are businesses that sell products people need, regardless of the prevailing economic climate. People still brush their teeth during a recession. They still purchase essential household products. They still require critical health care. These are profoundly defensive businesses boasting truly incredible track records. And by owning them through this particular ETF, you gain exposure to all of them in one simple, elegant investment. Here's why I absolutely love this fund for retirees. First, the dividend yield is consistently solid, typically hovering around 2.5% to 3%. That's real, dependable cash flow you can absolutely rely on. Second, those dividends systematically grow over time, providing a crucial hedge against the erosion of inflation. Third, and this point is critical, when the market inevitably crashes, these companies demonstrably hold up better than almost anything else. Why? Because they are essential businesses with rock-solid balance sheets. During the harrowing financial crisis, and again during the swift pandemic crash, these dividend aristocrats declined less than the broader market and crucially recovered significantly faster. That is precisely the resilient performance you need when your livelihood depends on your investments. The expense ratio on this fund is incredibly low, typically around 0.35% or even less. This means you're retaining more of your hard-earned returns instead of needlessly lining the pockets of some underperforming fund manager. I cannot tolerate high fees. They are a direct assault on your wealth. And in retirement, you need every single dollar tirelessly working for you, not for Wall Street. Now let's transition to the second exchange-traded fund, and this one is entirely centered around bonds. I know, bonds sound inherently boring. Everyone thinks bonds are exclusively for old people. Well, guess what? If you're retired, you are old, at least in investing parlance. And bonds, my friends, are about to become your very best friend. But we're not talking about just any bonds here. We're talking about a specific type of bond fund that meticulously focuses on short-term, high-quality corporate and government bonds. Why short-term? Because when interest rates inevitably fluctuate, short-term bonds don't suffer the devastating capital losses that long-term bonds do. They are inherently more stable. They are significantly less volatile. And in a rising interest rate environment, you're not trapped holding bonds that have lost a substantial chunk of their value. You demand flexibility, and short-term bonds provide precisely that. Plus, they still consistently pay you income. It might not be as stratospheric as a long-term bond, but the unparalleled safety is an invaluable trade-off. This particular bond ETF typically holds bonds issued by investment-grade corporations and U.S. Treasuries, meaning you're lending money to the most creditworthy borrowers on the planet. The risk of default is incredibly low. You're certainly not going to get rich from this fund, but that's not its purpose. Its singular purpose is to comprise a portion of your portfolio that remains remarkably stable, reliably generates income, and crucially tends to rise when stocks decline. That's the sheer beauty of incorporating bonds into a diversified portfolio. They zig when stocks zag. During an inevitable market crash, this bond fund acts as your indispensable shock absorber. When everyone else is consumed by panic and indiscriminately selling stocks, bonds typically appreciate because investors instinctively flock to safety. This means that while your stock holdings might be temporarily down, your bond holdings are holding steady or even increasing, which significantly cushions the blow to your overall portfolio. This is why every single retiree absolutely needs bonds. It's not about being conservative for conservatism's sake. It's about being profoundly smart and meticulously protecting yourself from catastrophic losses. The yield on this fund might range around 3% to 4% depending on prevailing interest rates, and its expense ratio is minuscule, often under 0.1%. You're essentially gaining access to institutional quality bond management for almost nothing. That's an extraordinary deal, and a primary reason I strongly advocate for ETFs over attempting to purchase individual bonds yourself, which is often complex and prohibitively expensive for most individual investors. Now we arrive at the third essential exchange-traded fund, and this one masterfully brings everything together. This is a balanced fund that strategically holds both stocks and bonds in a conservative allocation. Think of it as a convenient one-stop shop for retirees who prioritize simplicity above all else. You acquire this single fund, and you immediately gain instant diversification across multiple asset classes without the arduous task of rebalancing it yourself or agonizing over getting the asset mix perfectly right. These balanced funds typically maintain an allocation of around 40% stocks and 60% bonds, or sometimes a 50-50 split, depending on the specific fund's mandate. The equity portion provides essential growth potential and dividend income, while the bond portion delivers critical stability and safety. It's truly the best of both worlds, elegantly packaged into a single ticker symbol. For anyone who prefers not to obsess over their investments daily, who simply wants to set it and forget it, this type of fund is absolutely perfect. What I particularly admire about these balanced funds is their inherent automatic rebalancing feature. When stocks experience a significant upward surge, the fund automatically sells a portion of those appreciated stocks and reallocates the proceeds into bonds, returning to its target allocation. Conversely, when stocks undergo a crash, the fund performs the opposite maneuver. It buys stocks at significantly cheaper prices, utilizing its bond holdings. This intelligent mechanism effectively forces you to buy low and sell high, which is precisely the optimal strategy, yet one that most individuals struggle with because their emotions inevitably get in the way. The fund executes this automatically, thereby eliminating human error and emotional decision-making from the equation. The returns generated by these balanced funds aren't designed to blow your mind, but they are consistently reliable and predictable, which is precisely what you desperately need in retirement. Over the long term, you can realistically expect something in the range of 5% to 7% annual returns, on average, accompanied by significantly lower volatility compared to an all-stock portfolio. And most importantly, when the market inevitably crashes, these funds do not collapse. They might experience a drop of 10% or 15% instead of a devastating 30% or 40%, which means you can remain calm and steadfastly adhere to your well-thought-out plan instead of succumbing to panic and making irreversible, terrible decisions. The expense ratios on these balanced funds are also remarkably low, typically under 0.2%. You are essentially receiving professional asset allocation and automatic rebalancing for virtually nothing. Compare that to paying a traditional financial advisor 1% of your assets every single year, and you can clearly understand why I champion these funds. You're saving thousands of dollars in fees while often achieving the same or even superior results. Now here's the strategic approach I recommend for the vast majority of retirees, and this is critically important, so pay meticulous attention. You don't have to select just one of these funds. In fact, you almost certainly shouldn't. The intelligent strategy is to deploy all three together in a carefully calibrated mix that precisely aligns with your personal risk tolerance and your specific income requirements. If your need for current income is substantial, you might prudently allocate a heavier weighting to the Dividend Aristocrat Fund and the Bond Fund. If you possess the capacity and desire to accept a slightly higher degree of risk in pursuit of additional growth, you might incrementally increase your allocation to the balanced fund. The fundamental key is to construct a portfolio that affords you profound peace of mind, allowing you to sleep soundly through the night. I have witnessed far too many retirees who were unwisely persuaded into aggressively structured portfolios by advisors who brazenly promised them the moon, only for them to discover, when the market inevitably plunged, that they simply couldn't psychologically endure it. They impulsively sold at the absolute worst possible time, locking in catastrophic losses from which they will never fully recover. That, my friends, is a tragedy, and it is entirely avoidable if you meticulously build your portfolio correctly from the outset. Consider it this way: if you have $1 million diligently saved for retirement, you might judiciously allocate $300,000 to the Dividend Aristocrat Fund, another $300,000 to the Short-Term Bond Fund, and the remaining $400,000 to the Balanced Fund. This intelligent allocation provides you with comprehensive diversification across distinct strategies and various asset classes. You've secured a reliable income stream from dividends, robust safety from bonds, and essential growth potential from the balanced mix. When one segment of your portfolio experiences a downturn, another segment is highly likely to be holding steady or even appreciating. And that, my friends, is the profound beauty of this holistic approach. You are not recklessly placing all your precious eggs in one fragile basket. You are not relying on a solitary strategy or a single asset class to carry you through your entire retirement. You have meticulously constructed an impregnable fortress around your money, and when the inevitable storms arrive, and they will arrive, you and your wealth will remain secure, while everyone else is running around in a desperate, panicked frenzy. Let me vividly illustrate what tragically unfolds when you fail to establish this critical protection. I've witnessed this dreadful scenario unfold time and time again. The market is soaring. Everything seems to be going up. People feel overconfident, perhaps even a bit cocky, convinced they are investment geniuses because their portfolio inexplicably surged by 20% last year. Then boom, a crash hits. Perhaps it's a global financial crisis, maybe it's a devastating pandemic, or perhaps it's some unforeseen catastrophe that we cannot even predict right now. Suddenly, their portfolio plummets by 30%, 40%, even 50%. And because they desperately require that money to live on, they are tragically forced to sell at the absolute worst possible time simply to cover their essential bills. That is a death spiral. Once you initiate selling during a crash, you are irrevocably locking in losses that you can never, ever reclaim. And here's the most devastating part. When the market eventually recovers, which it always unfailingly does, you do not participate in that recovery because you have already liquidated your holdings. You exited at the bottom, and now you're left sitting on a pile of cash, helplessly watching everyone else rebuild their wealth, while you're agonizingly trying to figure out how to stretch your meager remaining savings to last another 20 years. It's a genuine nightmare, and it is entirely preventable. This is precisely why the 3 exchange-traded funds I've just meticulously outlined are so incredibly critical. They are specifically engineered to prevent that nightmare scenario from ever materializing for you. The Dividend Aristocrat Fund continues to pay you consistent dividends even as stock prices are in free fall. The Bond Fund provides unwavering stability and often appreciates when stocks crash. And the Balanced Fund automatically rebalances, astutely taking advantage of market volatility without you having to lift a finger. Together, they seamlessly forge a portfolio that can confidently weather any storm. But here's a fundamental truth you must grasp about market crashes. They are not rare anomalies. They occur with predictable regularity. If you anticipate being retired for 20 or 30 years, you are, without a doubt, going to live through multiple crashes. That is an undeniable fact. The pivotal question is, will you be meticulously prepared for them, or will you become yet another tragic victim? The choice unequivocally is yours, but you must make that critical choice now, before the next crash inevitably happens. I want to discuss something that, in my view, never receives nearly enough attention: the profound psychology of retirement investing. This is where the majority of people ultimately fail, not because they selected inherently bad investments, but because they simply couldn't withstand the emotional roller coaster. When you're actively working and diligently contributing money to your retirement account every month, a market crash, paradoxically, can actually be a good thing because you're effectively buying more shares at lower discounted prices. But when you're retired and actively drawing money out of your portfolio, a crash feels absolutely terrifying because you're helplessly watching your precious nest egg visibly shrink while you're still needing to spend from it. This treacherous phenomenon is known as sequence of returns risk, and it represents one of the single greatest dangers retirees face. If you happen to retire immediately before a major crash and are then forced to sell shares at rock-bottom prices to fund your essential lifestyle, you can permanently and irrevocably damage your portfolio's long-term ability to sustain itself. But if you possess the precisely right mix of assets, if you have those resilient bonds and reliable dividend-paying funds providing crucial stability and consistent income, you are not compelled to sell your stocks at the absolute bottom. You can judiciously live off the safer, more stable components of your portfolio and patiently allow the stock portion ample time to recover. That is the entire game right there. Let me provide you with a concrete, real-world example. During the catastrophic financial crisis, the stock market plummeted approximately 50% from its peak to its trough. If all your money was in stocks and you required, say, $50,000 annually to live on, you were tragically forced to sell twice as many shares to obtain that money compared to before the crash. That's utterly devastating. But if you had a prudently constructed portfolio like the one I'm describing, featuring a strategic allocation to bonds and dividend funds, you could have confidently drawn that $50,000 from those stable sources and never once touched your stock holdings. A few short years later, when stocks inevitably recovered, your portfolio would have been in superb shape instead of being permanently crippled. This, my friends, is precisely why I am so intensely passionate about this particular strategy. It's not theoretical, it unequivocally works. I have personally witnessed it work through multiple brutal crashes. I have seen it meticulously protect people's retirements, while their neighbors, who were foolishly invested in aggressive, undiversified portfolios, were utterly destroyed. The critical difference between success and catastrophic failure in retirement often boils down to how you strategically navigate these inevitable crashes. And the single most effective way to navigate them is to construct a portfolio that robustly ensures you are never forced to make terrible, emotionally charged decisions under immense pressure. Now, I want to address a concern I know some of you are harboring. You're thinking, Kevin, these funds sound safe, but what about growth? What if I live to be 95? Won't I inevitably run out of money if I'm playing it too safe? It's a very valid question, and here's my concise answer. First of all, these funds do provide growth. The dividend aristocrats consistently grow their dividends over time, which means your income stream is steadily increasing. The balanced fund inherently maintains stock exposure, which appreciates over the long term. You are not sacrificing all growth for safety. You are intelligently finding the optimal balance. Second, running out of money isn't solely determined by how much your portfolio grows. It's also profoundly influenced by how much you spend and, critically, how you manage market volatility. If you possess an overly aggressive portfolio that crashes and you then succumb to panic and sell, you will run out of money much faster than someone with a conservative, well-structured portfolio who remains calm and steadfastly adheres to their plan. Behavior matters more than raw returns in retirement. I cannot stress that fundamental truth enough. Third, you always retain the flexibility to adjust. If you're 70 years old and your conservative portfolio is thriving beyond your wildest expectations, and you genuinely wish to assume a little more risk, you absolutely can strategically shift some money into more growth-oriented investments. But you do so from a position of immense strength, not from desperation. You make calculated, rational decisions based on your actual situation, not emotional decisions driven by fear or greed. That's how truly wealthy people think about their money, and that's precisely how you need to approach it too. Here's another profound truth I want you to internalize. The ultimate goal of retirement is not to die with the most money. The paramount goal is to live the life you desire without the terrifying prospect of running out of money. That might sound remarkably obvious, but you'd be utterly astonished by how many people completely forget that. They become so obsessively fixated on perpetually growing their portfolio that they fail to actually enjoy their retirement. They become paralyzed by fear, afraid to spend anything, perpetually worried about an uncertain future. That is no way to live. With the precisely right portfolio diligently in place, with these three powerful exchange-traded funds working in synergistic harmony, you can spend with profound confidence. You possess the unwavering certainty that you have a stable, reliable income stream flowing in. You know you are meticulously protected against devastating crashes, with absolute conviction that your money is going to last. That confidence, my friends, is utterly priceless. It empowers you to genuinely enjoy your retirement instead of spending every waking moment frantically checking your account balance and agonizing over the market's whims. Let me tell you exactly what you need to do right now. If you are not already invested in funds like these, you need to initiate a change immediately. I don't care if it means selling some individual risky stocks or divesting from other speculative investments. Your retirement is far too important to gamble with. Open a brokerage account if you don't already have one and begin constructing this essential portfolio. You can accomplish this yourself with minimal effort in about 20 minutes. It is not complicated. You are simply acquiring 3 robust funds. That's it. And here's the truly beautiful part. Once you establish this foundation, you will barely need to touch it. Perhaps once a year, you conduct a minor rebalancing if your allocations have drifted slightly out of whack. Perhaps you strategically reinvest your dividends or elect to receive them as cash, depending on your evolving needs. But for the most part, you literally set it and forget it. You are not day trading. You are not obsessively watching the news every day, succumbing to panic over every market fluctuation. You have meticulously built a powerful machine that reliably generates income and steadfastly protects your wealth. And now you simply allow it to run its course. This is the strategy of smart money. This is precisely how you survive market crashes. This is how you ensure you never have to tragically return to work at 75. And this is how you leave a meaningful legacy for your children or your cherished charity when you're gone. It all begins with having the precisely right foundation. And that foundation, my friends, is built upon unwavering safety, comprehensive diversification, and consistent cash flow. Before we conclude, I need you to do one last thing for me. If this video has genuinely helped you, if you have gleaned something truly valuable from my blunt advice, I want you to hit that like button right now. It is crucial. It helps more people discover this vital information, and more people desperately need to hear this message. Far too many retirees are currently making egregious mistakes that will ultimately cost them everything, and we absolutely need to get this word out. And if you still haven't subscribed, what in the world are you waiting for? This channel is entirely dedicated to protecting your wealth and empowering you to make truly smart money decisions. I am consistently releasing content that can fundamentally transform your financial life. Subscribe, hit that bell icon so you get notified, and become an integral part of this burgeoning community. We are building something extraordinary here, and I want you to be part of it. Leave me a comment below and tell me, are you going to implement this crucial strategy? Do you already own funds like these? What's your single biggest fear about retirement? I personally read every single comment, and I genuinely value hearing from each of you. This is how we collectively learn from one another and become more adept with our money. Listen, I know I often come across as tough. I know I don't sugarcoat unpleasant truths, but that's precisely because I deeply care about your ultimate success. I've dedicated my entire career to building wealth and to helping other ambitious individuals build wealth. And I have learned unequivocally that the unvarnished truth is far more valuable than simply making people feel good. The truth, blunt as it may be, is that retirement is a terrifying prospect if you are unprepared. But if you are prepared, if you possess the precisely right strategy, it can, without a doubt, be the absolute best time of your entire life. You toiled diligently for decades. You meticulously saved your money. You made countless sacrifices. You profoundly deserve to enjoy your retirement without the suffocating burden of stress and crippling fear. And the 3 exchange-traded funds I've just shared with you are the indisputable foundation for making that glorious reality happen. They are not exciting. They are certainly not going to transform you into an overnight millionaire, but they are going to protect you when it matters the very most. Remember, in retirement, the game isn't about hitting audacious home runs. It's about not striking out. It's about steadfastly remaining in the game long enough to unequivocally win. And with these 3 indispensable funds diligently woven into your portfolio, you are guaranteed to stay in the game no matter what unpredictable challenges the market hurls your way. That's a solemn promise. That's Mr. Wonderful's ironclad guarantee to you. Now get out there and seize absolute control of your financial future. Build that robust portfolio, protect your cherished retirement, and live the life you unequivocally deserve. Thank you for watching, and I'll see you in the next one.